Yeah, joining us now is Rob Russell, president of Russell, of course, Company, and still with us is our guest host, Ellen Zentner, who is here with me. Rob, let's start with you and talk about this tug of war that we're seeing between Europe and the United States. In some ways, the debt crisis in Europe overshadowing what we're seeing here at home, but we've also had some positive signs that things are slightly getting better domestically in the States. What's your take on this? Is the focus going to continue to be Europe, or do we start to shift away and look at some of the other issues?
Yeah, without a shadow of a doubt, the focus is going to continue to be on Europe as they try to resolve all the debt issues and the growth issues that they have. And, you know, once that's resolved, you're right. The focus will come back on the United States, and we'll have to deal with the issues that we have here stateside, and unemployment, lower growth, more of a stagflation-style economy right now. And that's when, you know, there'll be more of a reckoning. You know, there'll be more back to fundamentals, and we'll have to focus in on protecting wealth in these kind of markets. Look, we're in the middle of a secular bear market here in the U.S. and certainly in the European Union. I think it's important right now for people to look at alternative strategies to the normal buy and hold.
All right, quick question for you, and then I want to bring Ellen in, who has a question for you as well. But talk to me about some of the encouraging data that we've seen. For example, we saw our third quarter GDP number was slightly better. We're seeing some encouraging retail data. Are things as bad here as some of the analysts and perhaps yourself might think?
Yeah, I mean, we are seeing encouraging data, and that is certainly hopeful. However, there's a lot more underlying tones. You know, the encouraging data is more short-term data. Like you said, the retail sales and so on and so forth. We still have an extremely sluggish economy, and we still have very, very high unemployment. And GDP over the, you know, a longer period of time, while we've seen some level of growth, will continue to be chokehold by what's going on in Europe and unemployment being so high. So this is going to be a long-term problem. We're going to get out of this. That's the good news. It's just going to be a lot longer than many had predicted.
Rob, this is Ellen Zentner in New York, and I have a question for you. If markets right now are so focused on Europe, and rightfully so, would the risk of a further, or has the risk of a further U.S. credit downgrade, is that enough to draw their attention back to the U.S., or will they just view that as another shade of gray since we've already gone through the initial downgrade?
Yeah, so I think that would be obviously not a positive thing if we went through another downgrade, and it may switch focus here temporarily, but the big issue in the world right now is the EU. The largest economy in the world is struggling and will continue to struggle as their financing costs. You know, look at the bond markets right now with yields pushing 7% or even a little above in some areas, and that is a dangerous game of Russian roulette. And so, yeah, while we could see downgrade here in the U.S., I don't think that's going to happen anytime soon. If that does happen, that will certainly bring eyes back. But look, all the headlines are going to be about Portugal and Italy and Greece and Spain, and that's going to continue for quite some time. We're just a few chapters into, you know, a horror story at this point.
You talk about, it's Becky in London here, you talk about investors ought to be looking for an alternative strategy to buy and hold. What do you advocate?
Yeah, so, you know, the buy and hold strategies, frankly, Becky, has really worked in really two markets in the 80s and 90s, and those are markets that we probably won't see for a very, very long time again. So we look for alternative strategies. Everything's correlated right now. If there's one thing you can learn from what's going on in the EU, it's how correlated everything is. So we try to look for alternative investments that don't have that correlation. And there's all kinds. There's oil and gas investments. There's managed commodity futures investments. There's real estate investments, commercial real estate investments. There's senior secured loan portfolios. There's all kinds of options that the majority of the retail investors, the average investors, don't have access to or don't understand. And it's strategies that the popular endowment funds like Harvard, Yale, and Princeton have used to decouple from all the risk that's going on here in the U.S. and specifically over in the EU.
Rob, just another point I want to pick up on. I believe that you expect that the U.S. is, or the dollar is facing potentially a loss of reserve currency status. So tell us about that.
Yeah, you know, and I hope I'm wrong. I really do. But I think, and we've actually seen proof of that. I'd hate to lose reserve currency status, but you're starting to see China, you're starting to see Brazil, you're starting to see Russia, and some other countries actually call for that, where it's more of a international reserve currency, more of a hybrid currency versus just the U.S. dollar. And if that happens, that will change things greatly in the United States. And again, I hope it doesn't happen, but we're starting to see more and more of that pressure. And in terms of timing, it may never happen, but it could happen in the next 7 to 10 years, and that will change things greatly. As you know, when you go to buy oil or coffee beans anywhere in the world, you're buying them in U.S. dollars, and the countries, the emerging markets, the emerging economies like China and Brazil and Russia, they're calling for a hybrid reserve currency, and that will certainly be very dramatic here in the U.S.
And Rob, just give me quickly your take on T-bills. Obviously, we're seeing a lot of investors using the T-bill, the 10-year, as a flight to safety here in the States as the risk in Europe is rising. But you say it's creating a bubble?
Yeah, what you're seeing here is what we say is actually the next big bubble. It's rare that we get a peek in to see, you know, what the next big bubble is, whether it was the technology bubble or the subprime market bubble. This is the next big bubble, and when it busts, it's going to destroy a lot of wealth in the world, specifically here stateside, where people have flocked to the perceived safety of bonds. And that is because bonds have sensitivity interest rates. And interest rates, as low as they are, near zero here in the U.S., push bond prices up. And we're basically at a 30-year high in bonds. And it's anybody's guess as when interest rates will heat up here in the U.S. Our hunch is in the next 3 to 5 years. And when that happens, that will push bond prices down dramatically. A 1% interest rate increase will drop longer-term bonds down by 15% on average. That's how risky they are right now.
Yeah, that's a great point. But at the same time, as you said, we don't really expect the interest rates to rise anytime soon. 3 to 5 years is a little bit of a longer time horizon. Thank you so much, Rob Russell, president of Russell and Company. And, of course, he's got Ellen Zentner. She's the senior U.S. economist at Nomura. She is staying with us.